In the previous lectures, we have explored some of the fundamental building blocks of technical analysis, such as support, resistance, and trend lines. You've learned to interpret these individual levels, understanding how they can help us predict potential price movements and set good levels of stop loss and take profit. In this lecture, we're going to take these building blocks and start to assemble them into more complex structures, moving from simple lines and levels to more intricate formations called chart patterns. Chart patterns are graphical representations of price movements that are identified through a series of trend lines and key levels, so they are built from the elements we've studied so far, such as support, resistance, and trend lines. In this lecture, we will explore the most common and useful types of chart patterns. Let's start with channels. A channel is a chart pattern formed by two parallel lines. An up channel, also called ascending channel, is formed by two uptrend lines. A down channel, also known as descending channel, is formed by two downtrend lines. And a sideways channel is formed by a support and a resistance. As usual, I immediately want to check some examples in real market conditions. I think that the best way to improve in forex trading is by spending time on the charts and study real market examples. Here we have pound against US dollar on a 4-hour chart. Overall, the price seems to be in an uptrend, so we want to see if we can draw an uptrend line connecting higher lows. Yes, it seems that we can connect at least 3 relevant higher lows representing this uptrend. Now, we know that in an uptrend we usually not only have higher lows, but also higher highs. In this chart, it does seem that the highs are increasing, so we can try to draw a trend line connecting higher highs as well. Instead of drawing another trend line, I delete the previous one and I'm going to select parallel channel. Now, let's draw again the uptrend line that we had at the bottom, just as we have seen for a normal uptrend line. Once we've done that, we can simply drag the cursor around and it will draw a parallel line. So we can check if we can use a parallel line to connect the higher highs as well and form an up channel. Yes, with something like this, it seems that the uptrend line at the top works very well, so in this case we have two parallel uptrend lines forming an up channel. In general, a channel is an improvement of a trend line. If we only had a trend line at the bottom, we will know where to place our entry and where to place our stop loss, but we will need to think a bit more about the take profit. With a channel, we have our market structure defined by a lower limit and an upper limit, so we can also easily place the take profit inside the market structure. For example, let's say that after the first few bounces, we want to consider a long position when the price approaches again the bottom of this ascending channel. Here we have a nice rejection on the trend line, so we open our long position right after the formation of this candlestick. Where to place the stop loss? Outside the market structure, so slightly below this uptrend line. Where to place the take profit? Inside the market structure, so below the trend line we have at the top. So with a chart pattern we have a complete market structure, and it is generally easier to set up our entry and exit points compared to individual key levels. One thing that I want to mention is that you should always trade in the same direction of the trend we have on the market. So with an up channel, we obviously have an uptrend, so you only want to consider long positions. Why is that? First of all, it is much easier to profit from trading when your trade is in favor of the trend. Secondly, trading against the trend identified by the chart pattern will give you a hard time when placing stop loss and take profit. For example, let's say that you want to enter a short position when the price approaches the top of this up channel. A reasonable trade will be here when the price approaches the upper part of the channel and then it starts to go down, showing a good rejection. Stop loss outside the market structure, so we place it above the trend line at the top. Take profit inside the market structure, so we place it above the trend line at the bottom. Now, as the trade proceeds, you will soon have the stop loss stepping inside the market structure and the take profit stepping outside of it. So you will either need to settle for stop loss and take profits that do not follow the logic we have explained in this course, or keep changing them to keep them respectively outside and inside the market structure, and settle for a very large stop loss, which means a high risk, and a very small take profit, which means small potential profit. So remember that we always want to trade in favor of the trend we have identified. For the rest, it's just a matter of applying the main concepts of market structure, rejection, and breakout, just like we have seen for support, resistance, and trend lines. Okay, we took a bit more time for the first example because I wanted to make sure that all the concepts were clear, but now we can speed up through the rest of the chart patterns. I'm sure that you will know exactly how to trade them, even if it is the first time for you to see them. In this example, we have Australian dollar against US dollar on a 1-hour chart. We have a downtrend as it seems that highs and lows are decreasing. Let's see if we can draw a down channel. I start by drawing a line that connects lower highs, as it is the main condition in a downtrend. Then I want to drag this line down and see if I can connect lower lows. Yes, it seems to work very well, except for this period of small breakout that doesn't really concern us. How do we trade this market structure? First of all, we only want to look for short positions, as the market is in a downtrend. Let's say that we wait for this bounce here, we open our short position, and as usual, stop loss outside the market structure and take profit inside the market structure. I think it's pretty easy once you understand the main concepts. There is no need to memorize dozens of chart patterns and memorize how to trade them. It's all very logical. The next chart pattern we're going to see is called a wedge. How is a wedge formed? It is formed by two trend lines which become closer to each other over a period of time. So the wedge shape is wider on the left-hand side than on the right, unlike the channel which has always the same shape because it is formed by parallel lines. Technically, the two trend lines forming the wedge go in the same direction. If we have two converging uptrend lines, we call it a rising wedge. If we have two converging downtrend lines, we call it a falling wedge. Let's see some live examples. Here we have Euro against Canadian dollar on an hourly time frame. Looks familiar? Yes, this is a chart we have already traded in the lecture about trend lines. We didn't know that this formation is called wedge, a falling wedge in this case, but we knew how to trade it because we have mastered the concepts of market structure, rejection, and breakout. In this example, we have Euro against Japanese yen on a 1-hour chart, and we have a clear uptrend, so let's try to draw an uptrend line connecting high lows. Okay, now let's see if we also have an uptrend line at the top that connects higher highs. Yes, it looks like a good one. These two trend lines are both going up and they are converging. They are not parallel. So we technically have a rising wedge. I don't care if you don't remember the names of the chart patterns as long as you know how to trade them. Here we wait for a bounce on the uptrend line at the bottom because we want to look for an opportunity to open a long position, and here we seem to have one with a good rejection, so we enter after this strong candlestick, we place our stop loss below the first uptrend line, and then we place the take profit below the second uptrend line. Easy as usual. The next chart patterns we are going to see are triangles. A triangle is a combination between a horizontal line and a trend line. In case of an ascending triangle, we have an uptrend line at the bottom and a resistance at the top. In case of a descending triangle, we have a support at the bottom and a downtrend line at the top. Let's have an example. We have Australian dollar against Canadian dollar on a 15-minute chart. We can first draw a horizontal level at the top to identify resistance. Then we can see if we have an uptrend line at the bottom connecting higher lows. Yes, something like this. So we have an ascending triangle. Obviously, with an ascending triangle, we want to look for long positions, just like we want to look for short positions in a descending triangle. One trade that could have been placed here on this rejection with a stop loss outside the market structure and the take profit inside the market structure. Now, typically, triangles are chart patterns that go very well with breakouts because the two key levels tend to converge very fast, and at one point we will have a breakout of the market structure. We can still trade rejections inside it, but if you find it difficult, you can avoid trading triangles with rejections. We have so many other market structures, and at the end, your job as a trader is to find setups that make you profitable. If you practice and find out that triangles are not for you, don't trade them. You are not the only trader not feeling comfortable trading this market structure with rejections. So don't worry about it, you have plenty of other opportunities to make money. Here we have another example, and I'm very happy to show you this, as these are two trades that I have recently taken with my real account. We are on pound against Swiss franc daily chart. We have the highs that are decreasing, so I drew a downtrend line highlighting these lower highs. Then we have a horizontal key level at the bottom, so we have a support. Together, these two key levels identify a descending triangle. Once I identified this market structure, I wanted to trade with short positions and take advantage of the downtrend. My first position was here on this nice rejection on the downtrend line. This trade is also supported by candlestick analysis, as there is a very strong gravestone doji, something we will see in the lecture about candlestick analysis. I know I'm repeating myself, but very easy stop loss and take profit respectively outside and inside the market structure. And then I had a second trade here with the same logic. This time I had an additional reason to enter, as the Swiss National Bank announced that they were going to increase the interest rates, which typically leads to a stronger currency. We will study this in the section about fundamental analysis. Now, you can see that this second trade didn't go well. We will talk about win rate and how to handle losses in trading, but one thing I want to make clear from the start is that you are not going to win all the trades. Even if you dedicate your life to trading and have 50 years of experience trading the markets using the latest technology and having a qualified team advising you, you are still going to lose some trades from time to time. We will talk about this in the section on money management and psychology. The last chart pattern we're going to look at is a symmetrical triangle, which is commonly known as a pennant. This pattern is formed by a downtrend line at the top and an uptrend line at the bottom. Now, technically, this formation is called a symmetrical triangle, while it is called a pennant when we have a strong movement before it, as you can see that it resembles a pennant. It is really just a small difference in the terminology, but they totally express the same market action. How do we trade a symmetrical triangle? The two trend lines of the symmetrical triangle converge very fast, which often gives great opportunities to trade with breakouts rather than rejections. So I wanted to show you this chart pattern because it is a very popular pattern among traders and technical analysts, but we're not going to use it in the trading strategy we're going to build in this course. This concludes the lecture about chart patterns.